Joining us in the second half of the program here on Dollars and Cents with Joel Garris of Nelson Financial Planning, Kristin Kalley of Nelson Financial Planning, also a fellow certified financial planner, fellow certified financial fiduciary. But what is unique about Kristin is that she is also a CPA. Welcome to the program.
Thanks, Joel. Happy to be here.
So the folks in Washington threw a bunch of stuff in this budget bill that they passed at the end of last year.
Yep.
And once again, I doubt very seriously that they actually read it.
I agree with that. Certain provisions don't make too much sense.
And so that's part of what you've been doing this past week, is trying to get through some of the details, if you will, on it. So let's start with sort of the biggest highlight that has made a lot of the headlines so far, and that has to deal with required minimum distributions.
Yep. So the Secure Act 2.0 actually increased the RMD age from 72 to 73.
And that applies for 2023.
Correct.
So if you were fortunate enough to kind of be born in 1950, then because they keep bumping the age up, then you've been able to dodge a required minimum distribution for a couple of years now because they keep throwing the age up. So that's interesting. But of course, if you were born in 1950 or before, if I'm doing the math right in my head, then you've got the required minimum distribution.
Yeah, starting this year, 2023.
But there is some good news on that if you are not paying attention, because they also changed the penalty.
They did. They actually decreased it quite a bit. So it used to be 50% if you missed RMD distribution, but now it's down to 25%, and in some cases it can even be 10%.
So what's that situation where you wind up, because that's like a special deal, if you will, where that penalty, because the 50% penalty, folks, was I think one of the most draconian penalties in the entire tax code. When you stop and think about, okay, if I don't take a required distribution, I'm going to get hit with a 50% penalty. Oh, by the way, it's also taxable. I mean, if you're in a high tax bracket, there goes 80-90% of the entire amount of money. The only good news on that is that generally we saw that was not a highly enforced penalty. But so that's the marginally good news. The bad news that comes with the reduced penalty is I suspect that they may be looking to increase enforcement then.
Right. There is that one situation where you can get a 10% penalty if you miss the RMD, but you have to take it within the next year. So if you miss it for 2023, so long as you take it in 2024, you can get that penalty reduced to 10%.
So that is good. A little bit of a correction allows the taxpayer to sort of correct the mistake and not slap them too much on the wrist in terms of that required minimum distribution. So the required minimum distribution age goes to 73. If you're a beneficiary of an IRA, though, what's the deal there? Because that's a different set of rules.
Yeah, so that actually just changed as well. So we were talking about it on a couple of previous shows where we thought with the inherited RMDs that you had the 10-year period to liquidate the account as you wanted. But now we found out that beginning in 2023, you actually have to take an RMD each year within that 10-year period and also liquidate the full account.
So this goes to the new rules that happen post-2020 that deal with when you inherit an IRA, you no longer get the ability to spread that out over the course of your lifetime like you used to. Now, obviously, if you are a spouse, different set of rules apply. You can assume that as your own. We're talking about non-spousal beneficiaries prior to 2020 had the ability to take that out over the rest of their lifetime. 2020 changed that, said 10-year rule. There wasn't a lot of specificity, so a lot of folks were saying, well, then you've got 10 years to do it. So you could wait to year 6 and then start, depending upon where you were in terms of your retirement journey, maybe you get some flexibility, but that's not the entire case in terms of that flexibility.
Right. So now if you are one of those people that fall into that category where you inherited an account after 2020 or during 2020, you have to take an RMD each year.
But that doesn't mean, now the RMD is based upon what? Is it based upon my life, account owner's life? Kind of what is that how does that break down?
I believe it's based upon your life, but we need some more regulations to
figure exactly what that is. But the good news is then, though, that it's just a required minimum amount. It's not like it equates to 10% of the account.
Right.
So there is still some flexibility for someone to say, okay, I got to take my minimum amount out, but I can push a lot of that to a little bit later on if I wanted to.
Exactly. Yep.
So that's at least some flexibility. Now, the IRS has issued some guidance on this that gives people an out if they haven't done this the way that they now say that they need to do.
Mm-hmm. Yep. So if you did not take an RMD the past 3 years, if you inherited the account in 2020, there is relief for each of those years. So you don't need to go back and make up any missed RMDs, just starting moving forward. In 2023, you need to start taking those RMDs.
So you sort of get a pass if you were kind of operating under the assumption that the rules weren't clear and you were waiting on them to actually come out with some real guidance. They're not going to penalize you. That's good, that they're not going to penalize you for being completely unclear in terms of their rules that they have with respect to these required minimum distributions. One more thing back to the required minimum distribution age. There was also another piece in there that we want to share with our listeners. What was that piece, Kristin?
So the age for the qualified charitable distributions, it has not changed. It still remains at 70 and a half, which was what it was before the Secure Act passed back in 2020. So that still stays the same. So you can make a QCD as long as you're over 70 and a half.
And that's a great way to be able to donate to a charity, get the immediate write-off in terms of the taxation of that income. Really an option that we advocate strongly for those that are charitable-minded at the office, because why not? I mean, otherwise, a lot of people don't get the charitable write-off like they used to, particularly with the much higher standard deduction, which I guess is the good segue to the other thing that happened in terms of the changes for the course of the past year.
Yeah. So there's been some changes to charitable contributions. So for the past 2 years, we were able to take a above-the-line charitable distribution or charitable deduction, and that was available to everybody. So either if you didn't itemize or you just took the standard, you would be able to take this deduction. It's a pretty small amount. It was $300 for single filers and $600 for married filers, but it was still something that you could get a deduction for making those contributions.
At least something that said, okay, if I give money to a charity, I'm going to get some tax savings. And not that that is the end-all, be-all for most people who donate to charity, but it's a nice little kicker, right? That if you're donating to a charity, you wind up getting a tax savings on that. Obviously, that goes away, which is unfortunate because a lot of people these days with the much higher standard deduction find that they're simply not able to get a tax write-off directly for those charitable contributions. Only way to really do that, and that's why the qualified charitable distribution from an IRA as part of your required minimum distribution is such a big issue. On the required minimum distribution, there was also something in there that pushed the age up even later in later years, right? So they've already got it pegged. So we're going to 73 for the year 2023, but then they've also got it pegged to do a different year, a different age going forward.
Yeah, so there's a 10-year period that it's going to stay at age 73, and then starting in 2033, it's going to increase from 73 to 75.
Yeah, so that's kind of weird. I mean, and obviously we're talking about a bill that came out of Washington, so everything there is weird. But I just don't understand why you wait 10 years. I mean, here we are, and it's like 3 years in a row where they've increased the required minimum distribution age from 70 and a half to 73. Huge jump within a very, very short period of time. Now we're going to wait 10 years, and then it's going to go up by 2 years. Why isn't there like 5 years it goes to 74, and then anyway?
I don't know. Your guess is as good as mine.
Well, and I think a lot of folks in Washington are doing just that in terms of projections and finances and a lot of these bills that get passed. So, well, that's the side on the required minimum distribution. What about limits to like 401ks, things like that? Those obviously changed, but that was more related to inflation then.
Right. Those all went up.
So we're going to, when we come back from the break, we're going to talk about those higher contribution limits for things like 401ks, health savings accounts, all of that when we continue here on Dollars and Cents with Joel Garris and Kristin Kalley of Nelson Financial Planning.